Good afternoon, Angela Wright with Del Monte Group, here to provide you with a clear-eyed view of the conflict in Ukraine and impact on your investments. Quick review of the facts. This map on the screen shows the area of Ukraine in brown that is currently being held by separatists, which are groups that want to make their own country. Think state of Jefferson folks here in California. Russia has essentially seized this opportunity to back the separatists to weaken Ukraine, moving troops into the brown areas. There are many ideas about what Russia will do next. Invade quickly and take over Ukraine, slowly squeeze them, etc. The idea of a world war with Russia is terrifying. Trust me, I came of age during the last years of the Cold War. But there's an extremely low probability that violence will hit our shores, so please don't worry about that. Here's the reality of the impact on US investors, which is real. Russia makes up about 0.08% of a globally diversified equity portfolio, and less than 0.05% of a 60% equity, 40% fixed income allocation. However, there is a broader impact on the global economy. It's not just about Russia or Ukraine. For example, Ukraine and Russia are big producers of natural gas, oil, and wheat. That said, Ukraine is a minor player in the global economy, only producing 0.18% of world GDP. Russia produces about 1.75%. So combined, we're talking about only 2% of global GDP impacted here. Italy, with half the people and fewer natural resources, has an economy twice that size. And Poland exports more goods to the EU than Russia. Russia's basically a big gas station. So the EU will see higher gas prices and potentially shortages. Countries like Egypt and Turkey will suffer from lack of wheat that they import from Ukraine and higher prices. But this will have a short impact on globally diversified portfolios because these shortages will be but a blip compared to what we saw with the pandemic shutdowns and supply chain issues. We just went through this, and look at how quickly our markets recovered from that. I never would have believed that the 2020 and 2021 market performance that we saw had you told me in advance it was going to happen. So I want you all to remember two things. First, the market is already pricing in all available information in real time. So it has already considered all of the awful war possibilities and shortages, and it's only down 8% year to date, which is not even considered a correction. That's 10%. The markets are worried, but only slightly. And this is a reasonable decline considering Russia and Ukraine's impact on the global markets, as I just discussed. Second, conflict doesn't always lead to a losing market. An easy example of this is World War II. Despite there being the largest conflict in modern history, the US market more than doubled from 1940 through the end of 1945, which are the dates that we were participating in the war. For a more modern and analogous example, we can look at how the markets performed in the US and abroad from 2013 to 2015. These dates include July 2014, which you might not remember. Russian-backed rebels shot down a commercial passenger plane, as well as Russia invading an annexation of the Crimean Peninsula from Ukraine. From the beginning of 2013 to the end of 2014, US markets rose 50%, and world markets rose 30%, even amid fears of Russia taking Ukraine. So we've been through this, and we've lived to tell the tale. Geopolitical issues are simmering all the time. And if you look back on history, very, very few geopolitical events impact markets for more than a few days. Let's look at one of my favorite charts. It's showing big market declines over the last 100 years. We're not even close to one of these at this point, but it serves as a great reminder of what's going to happen next. If we wind up in a big conflict with Russia, which is doubtful at this point, we may experience a decline. And if we do, look at what happens next. The market goes back up right after the decline. In fact, the market increases following these declines are massive in comparison. So what investors need to do is stay in the market and ride it out. This is not the time to run for the hills. In fact, if you do that, you're basically guaranteeing yourself an 8% loss as of today, and you're very likely going to miss the few trading days that will deliver the big gains to bring our market back. Timing the market simply does not work. This conflict will end, the news cycle will move on to something else, and we will completely forget this even happened, like the fiscal cliff, the Greek debt crisis, the mortgage crisis, and so on. So what's an investor to do? Well, stocks are on sale. It is Black Friday, so now is the time to buy. As I speak, Richard and our team are trading in our client portfolios where appropriate. If you've got cash sitting on the sidelines, now is the time to put it in the market. Once you've taken care of rebalancing your portfolio and buying stocks on sale, the only thing to do is turn off the news and take good care of yourself. Stay informed, of course, but bring your focus back to the long term. This conflict will be short-lived, and as will the economic impact. The most important thing that you can do right now is bring your focus back to the things that matter most. Your health, your loved ones, your long-term plans and goals, which will not be impacted by the news of today or even tomorrow. But they will be impacted by making good choices today, like buying stocks on sale when you have the opportunity. That's all I have for now. Hang in there, everyone, and please drop us a line if you want to chat. We're here for you. Take good care.